Hello everybody, it's Fung here again. Today we'll be talking about standard deviation. It's going to be a short lesson. And again, the information here is sourced from the book The Truth About Money by Rick Edelman. So getting started, what is standard deviation? Well, it's the amount of swing in performance that an investment can expect to have from year to year. So for investment purposes, this is the average variation from the average return. Now I don't want to dive too deep into statistics here, but looking here on the bottom, this chart, that is called a bell curve, right? It's basically how probabilities are distributed. So there's a 68% chance that it will fall within one standard deviation. There's a 95% chance that it'll fall within two standard deviations, and a 99.7% chance that it'll fall within three standard deviations. You can kind of think about it like playing darts. So hitting a bullseye, right? That's a very small chance, but hitting the board in general is a much higher chance, right? Just that distribution, kind of think about it like that. So for our investment purposes, let's do an example. Let's just say the standard deviation of stock X is 6, and that stock X has an annual average return of 8%. So for one standard deviation, we know that it can range between 2% to 14%. Why? Well, this is because you have the 8% from the annual average return, right? Plus or minus the 6, which is the standard deviation, right? So 8 plus or minus 6 is either 2 to 14. So that's one standard deviation, and if you look back to the chart, this has like a 67 to 68% chance of happening. Now, within two standard deviations for stock X, this will range between -4 to 20%. And this is because 8 plus or minus 12, right? Because 2 times 6, right? Two standard deviations, so 2 times 6, right? That's how you get those numbers. So we know that there's a 95% chance that it'll fall within two standard deviations. So what's the purpose of this, right, in our investing? Why is it so important? Well, it helps us look beyond the average annual return, because average annual return is what's always advertised when you look at investments. People always say, oh, the average annual return is so high on this and that. So let's look into an example of two different funds that have the same exact average annual return, but different standard deviations, okay? So looking at this chart that we have here, Fund A has no standard deviation and with an average annual return of 10%, while Fund B has much more standard deviation, right? But it also has an average annual return of 10%, right? So theoretically, we're going to invest $1,000. If you can see here on the bottom, Fund A actually returns more money for us, right? We make more money with Fund A compared to Fund B, despite both of them having the same annual average return. This is because of standard deviation, right? So standard deviation reveals a true level of risk for a fund, right? This way you can know the range and probability of an investment's performance, right? So it's very important to invest in different asset classes to mitigate this risk, right? The volatility here. So recapping everything that we learned. First is that standard deviation is the average variation from the average annual return, right? We know that there's a 67% chance that it'll fall within one standard deviation and a 95% chance that it'll fall within two. And also remember that slow and steady wins the race. Remember Fund A versus Fund B. Yes, Fund A had a lot less standard deviation and they both had the same average annual return, right? But Fund A performed better because it had less of that standard deviation. And then lastly is that standard deviation reveals a fund's true level of risk. With the higher the standard deviation, the higher the risk. So that's it for the video. Thank you guys for watching. Like, subscribe, do what you will. You guys are not obligated to do so. And I'll see you guys in the next one. Peace.